Quick ask. Subscribe now, then let's jump in with the numbers. New York has a reputation for being untouchable, a blue-chip market where homes disappear in days and prices only move one way. But 2025 is bending that story. Listings are lingering, price cuts are spreading, bidding wars feel rarer, quieter, less certain. Is your neighborhood next, or are you still assuming the old rules hold? If your plan depends on "it always sells here," you may be negotiating with yesterday. Tonight, we're pressure testing the narrative. We'll count down the 10 New York cities where momentum is slipping, where days on market are climbing, inventory is stacking up, and sellers are offering concessions they wouldn't touch a year ago. I'll show you what to watch, how to read the signals before they hit the headlines, and where buyers can gain leverage without stepping into a trap. Some names will feel obvious, others will surprise you. And the top spot? It isn't the city you're thinking of. If you want to protect your equity or time your entry, this is the playbook. Stay sharp, act early. To understand what's happening across New York in 2025, rewind to the surge that came after lockdowns. Remote workers fled pricier hubs, investors chased yield, and low rates poured gasoline on already tight inventory. Towns from Buffalo to the Hudson Valley accelerated, and downstate pockets rocketed as bidding wars normalized. Now the environment has flipped. Higher mortgage rates make every borrowed dollar heavier. Taxes, insurance, and HOA dues are elevated, so the monthly isn't just bigger, it's stickier. Pending sales are softer, days on market are creeping up, and inventory is rebuilding in select metros, especially where pandemic pricing ran hottest. Affordability ceilings are hitting first where wages can't chase payments, particularly downstate. Slower job growth and uneven office recoveries reduce urgency. Some buyers simply step back. Sellers who anchored to last spring's comps face the discipline of price cuts and credits. Meanwhile, mix shifts matter. Fewer cash investors and more contingent buyers change the rhythm of negotiations. None of this guarantees a crash. It signals deceleration. Some markets absorb the shock with incomes or leaner HOA footprints, while others stall until pricing meets reality. The countdown shows where momentum slips first. We rank losing steam with signals you can verify, not vibes. We look at a 3 to 6 month trend where days on market rise, active inventory builds, and the share of listings with price cuts increases. We pair that with slowing or negative median sale price growth, fewer pending sales, and a lower absorption rate. Then we pressure test the data, seasonality adjustments, holiday effects, and mix shifts. For example, more luxury listings that can distort the headline. If a city shows only a 1-week wobble, it doesn't make the list. The countdown highlights sustained deceleration across multiple indicators, so you can separate real shifts from noise and clickbait. We focus on evidence. At number 10, the capital region eases off the throttle. Think Albany, Schenectady, and Troy. Government and universities keep a floor under demand, but they don't erase gravity. Mid-tier resales that flew in a weekend now collect second looks and price cuts. Inventory has inched up, especially in 1950s to 1980s colonials that need updates, and buyers are running the math with sharper pencils. The signal to watch. Days on market stretching past the 30-day mark and list-to-sale ratios slipping a notch. Not a fall, but a measurable slowdown, enough to temper expectations today. Number 9 shifts us west to Niagara Falls and Tonawanda, where affordability still looks decent on paper, but momentum has thinned. Wages haven't chased prices, and renovation premiums on aging housing stock turn a deal into a bigger monthly than buyers expect. Roofs, windows, electrical, plus insurance raise total cost of ownership and slow first-time demand. Watch for more contingent offers and inspection items creeping back into negotiations. Sellers who priced to last spring linger, sellers who priced to today move. The spread between the two is widening, and so are days on market. At 8, Binghamton and Utica show the classic late-cycle posture. Longer marketing times, quieter open houses, and investors less aggressive than a year ago. Cash used to waive everything. Now it waits for concessions. Entry-level buyers face the same friction, repairs that lenders flag and premiums that insurers price in. True cost, not sticker, drives decisions. Track 3 tells a rising share of price reductions, pendings that fall out, and stale listings returning with new photos. When those stack together, momentum cools, leverage shifts, and patient buyers gain room to negotiate today. At 7, Syracuse shows how a boom cools without crashing. Neighborhoods that felt invincible, near the hospitals, the university, the new build edges, are running into payment fatigue. Builders still want premiums. Buyers don't want the monthly that comes with them. Concessions that vanished in 2022 are back. Closing credits, rate buydowns, appliances, even HOA prepaids. Days on market stretch, and the second weekend now matters more than the first. If you're shopping there, patience is leverage. Inspect fully, time your offer near month end, and make the math work on today's rate, not a hoped-for refinance. Number 6 is Rochester, where the entry level is feeling pinned. Rates keep the monthly heavier than headlines imply, and the homes that do pencil attract multiple maybe bidders instead of one reckless one. You'll notice relists, withdrawn and returned properties, and longer negotiation cycles as lenders, appraisers, and inspectors flag deferred maintenance. Sellers who price to last year revise. Sellers who price to the current comp sheet go under contract. For locals, the best move is practical. Widen your radius by 15 minutes, target stale listings, and ask for enough seller credit to buy the payment down. At 5, Buffalo is trading speed for scrutiny. After a strong multi-year run, appreciation is stalling and inventory is normalizing, especially in the mid-tier, where renovations drove pricing. Investors are shifting from flip to hold, or exiting when carrying costs outpace rents. That doesn't mean distress. It means buyers finally get a clean look. Watch for a rising share of price cuts on homes needing roof, window, or mechanical work, and prioritize condition over hype. If you're patient, you can structure a win. Inspection contingencies intact, credit for repairs, and a monthly that protects your margin when weather and budgets turn. From here, the signals sharpen and patience becomes your competitive edge. At 4, Yonkers and New Rochelle are meeting the downstate affordability wall. On paper, prices haven't collapsed. In practice, the payment has. HOA dues, rising insurance, and Westchester taxes stack on top of higher rates, turning many older condos and townhomes into tougher sells. Price cuts are sticking, inspection credits are back, and days on market drift past a month in the mid-tier. If you're shopping here, underwrite the monthly first, then the address. Track list-to-sale ratios by building and favor well-funded associations. At 3, White Plains and Mount Vernon still win the commute, but lose buyers at the closing table. All-in costs push past comfort, so sellers preemptively offer credits, appliance packages, and permanent rate buydowns to keep deals alive. Specific submarkets are slowing. Older elevator buildings with lean reserves and townhomes with rising fees. Renovated, realistically priced units still clear. Patient buyers compare thorough inspections with timing, submit after a second price cut or near month end. That's when leverage is highest and concessions expand. At 2, outer borough pockets show a mixed but unmistakable deceleration. Prime segments remain resilient, yet several co-op and condo tiers are stacking inventory and discounting deeper, especially where maintenance, assessments, or flip taxes overload the monthly. Absorption is slower outside trophy corridors. A standout unit can still trade fast, but average ones negotiate. Do the boring work. Read building financials, verify reserves, model assessments through 2026, and compare net monthly to comparable rentals. When brand prestige clashes with your balance sheet, choose solvency. And if this is number 2, imagine what waits at 1. At number 1, Long Beach. The allure is undeniable. Beach blocks, boardwalk living, express commute options, but the math now says pause. Over the last quarter, we see days on market climb, active listings stack up, and a higher share of price cuts. Pending contracts are lighter, and absorption has slipped. The story locals told themselves, "It always sells fast here," is giving way to a buyer window you can actually use. If you're shopping, underwrite the monthly, not the postcard. Taxes, insurance, HOA, special assessments. Ask for credits and a permanent rate buy-down and time offers after the second reduction. If you're selling price to today, not last spring, beauty still sells in Long Beach, just not at yesterday's speed. Use data, not nostalgia here. Here's how to turn signals into strategy. Buyers, stop chasing fresh listings and hunt the ones aging out. 21, 30, 45 days. That's where carrying costs soften sellers. Ask for closing credits and a permanent rate buy-down, not just a price cut. Underwrite the monthly, taxes, insurance, HOA, assessments, utilities. Read building reserves and minutes before you fall in love with photos. Time offers near month end or after the second reduction. Pair a clean timeline with inspection protections, not heroics. If the numbers still pinch, widen your radius or rent deliberately while you track days on market. Sellers, price to today's comps, not last spring's memory. Pre-inspect, fix the deal breakers, and it will. Sellers, price to today's comps, not last spring's memory. Pre-inspect, fix the deal breakers, and put incentives up front. Credit for rate buy-down, HOA prepaids, appliance package, so buyers see a solvable payment. Don't chase the market down with 5 tiny cuts. Make the right cut once, then defend it with superior condition. Now I want your ground truth. Are price cuts picking up on your block? Which buildings have rising fees or thin reserves? Drop your intel in the comments and I'll feature the most requested markets in upcoming deep dives. Your zip could be next or recovering first. Either way, we'll map the edge together today.